seen the consumer in America continue to get more and more and more in debt. Last summer, I did a video showing that we were over. In fact, the news was telling us that we were over $1 trillion in credit card debt. Now it's over $1.13 trillion in credit card debt. But in addition to that, there has been a surge of buy now, pay later services, installment loan services, which is different than credit cards. Credit cards are revolving, where you can pay it down, charge it back up. Installment loan services, buy now, pay later, tend to have a higher payment, but they are paid off in a certain amount of time. So at what point is this going to affect economic growth? We keep hearing the consumer's doing great. They're spending all this money, but they're not spending their own money. So it's got to catch up to people at some point, slow the economy down, slow the spending down, which would in turn, drop interest rates or have the Federal Reserve consider dropping rates more. But let's take a look at some interesting stats here. It might be concerning stats, but something to think about. So thanks to buy now, pay later, the headlines say that the consumer is resilient. 88 million or 34% of adults used buy now, pay later in 2023, and that's up 12% from 2022. That's a huge increase of people financing purchases of all kinds, large and small. 85% of consumers are paying over time for their purchases. 15% are paying in 8 weeks, 4 installment type chunks, which makes the payment a lot higher than actually a credit card would, because credit cards can spread it out over 20 to 30 years. So installment debts, on average, in the holiday pay, this is new data that came out. So holiday spending from last year, just a couple months ago, was $1,100 per person, average holiday debt spend on debt, right? The average cost per month for that is $105 on a buy now, pay later plan per month, as opposed to $32 on a credit card. So credit cards are more insidious over time, long term, because you can't pay them off quickly because they're revolving. And in many cases, well, I don't know, it depends on the deal, but a lot of times credit card interest rates are actually a lot lower than the buy now, pay later rates. Even though you pay those buy now, pay later loans off quicker, those have much higher interest rates even than credit cards, which are in the 20s, right, at this point. So it's kind of crazy. There's a lot out there, a lot of people spending money they don't have, especially over the holidays. So it'll be very interesting to see if that continues, or if these high payments start to catch up with people's budget. And they're like, okay, well, we got to slow down on the spending. We got to pay things off before we spend more, which would in turn slow the economy down, which would in turn encourage the Federal Reserve to lower interest rates. So it'll be interesting to watch how this comes out. Now, later on this week, there is a consumer spending report that comes out. So we'll see how that turns out. There's also a CPI, Consumer Price Index report that comes out that the markets love, right? They look at the headline Consumer Price Index inflation report, and that really informs the markets, especially the bond markets, and will for this week in particular. So that's coming out this week as well. So a lot of data. If anything market moving happens, I'll be posting on stories, etc., on Instagram to keep people in the loop. Otherwise, I will just do a recap of what happened this week with the spending reports and also the inflation report on my video next Monday. Follow me on Instagram, though, if you want more timely updates, midweek and on my stories, etc. And you can find me at the Bill Zimmerman on Instagram. Now, let's take a look and see what this has done to the charts and how the charts are looking. Obviously, we start with the 10-year Treasury. We always do. 10-year Treasury is the leading indicator for 30-year fixed mortgage rates. And as you can see, it has weakened a little bit today, which is good, right? Down on the 10-year Treasury. A lower yield means lower interest rates, but it is stuck kind of in this range between this Fibonacci level and the 200-day moving average. So what could cause it to fall down again, which is what we want to see, right? We want to see this fall through these floors, through the 200-day, through the 25-day, through the 50-day if possible, and just fall down there. Well, a really positive inflation report showing inflation coming to come down, especially core inflation, would cause that to happen. So we're going to have to watch this. Otherwise, for now, it's contained in this area here, but it sure would be nice to see it back where it was 2 weeks ago, where we had that nice downtrend going into the new year, going into February, and would love to see that happen again. So mortgage-backed securities, 30-year fixed mortgages and bonds, where are we at here? This is the opposite again. This is showing price. As price rises, yield and rate fall. So right now, we've seen it deteriorate a bit over the past week and a half, but it's kind of caught its footing here a little since late last week. Hopefully, we see this turn around, right, where we see price rise again with better than expected inflation data this week. We'll see what happens. And also weaker than expected, hopefully, personal consumption out there on the spending front with consumer confidence. We shall see. It'll be an interesting week. I will keep you informed. Again, follow me on Instagram, The Bill Zimmerman. Have a great day.